All right, let's dive right into this explainer. Today, we're unpacking a really fascinating, soon-to-be-published research profile from Signal Law Group, and it uncovers what looks to be an absolutely staggering destruction of retail shareholder value. We are talking about the dark arts of modern microcap finance here. You know, if you've ever found yourself wondering how everyday retail investors can completely lose their shirts while institutional insiders just walk away with millions, well, you really need to understand this one. We're going to focus specifically on the mechanics of floating conversion preferred stock, which is something the market often calls toxic financing. And we'll see how certain regulatory loopholes might be utilized by investment groups to just systematically drain value.
So just imagine seeing a company's share price completely obliterated by 98% in exactly 52 weeks. According to the research, that is exactly what happened to a company called TruGolf Holdings. Their stock plummeted from over $200 a share all the way down to roughly $3.50. I mean, just think about that for a second. For the retail investors left holding the bag, that isn't just a bad day at the office or a routine market correction. That is a near total wipeout. It's the kind of catastrophic loss that drains savings and just completely shatters your confidence in the market. But the really compelling question for us is how on earth did this happen so incredibly fast?
Well, a massive drop like that doesn't just go unnoticed, right? It actually triggered Signal Law Group's Vigilant Risk Engine. And this engine isn't just looking at a stock ticker. It's this advanced probabilistic tool that scans massive amounts of public data. And it immediately flagged TruGolf with a glaringly red, elevated risk score of 84 out of 100. That alert basically kicked off a massive deep dive investigation into the company's SEC filings, and what they found was wild. They uncovered this highly complex, heavily obscured web of financial mechanisms that was basically operating quietly under the hood of the public narrative.
Before we get into the how, we really need to understand who we're dealing with. So TruGolf is a consumer tech company out of Utah, and they make golf simulation hardware and software. They actually went public through a SPAC merger via Deep Medicine Acquisition Corp back in early 2024. And here is some absolutely vital context. The Class A common shareholders, many of whom were everyday retail investors rolling over from that initial SPAC, were the ones who bore the absolute brunt of this exposure. They bought into what looked like a fun consumer tech company, hoping for some solid long-term growth, and they were completely unaware of the intricate financial machinery operating behind the scenes that was perfectly positioned to dilute their ownership.
Okay, let's move right into Section 1, Anatomy of a Death Spiral.
Let's break down the architecture of what's called a death spiral financing structure. I know, it sounds super dramatic, but once you see the mechanics, you'll see exactly why the market uses that phrase. The core of the issue here is something called floating conversion Series A preferred stock. According to TruGolf's filings, this preferred stock converts into common shares at the lesser of a stated price or 90% of the lowest volume-weighted average price over the previous 5 days. It's basically like taking out a predatory loan where the worse your credit score gets, the more money you owe them by default. Every single time that common stock price drops, this specific preferred stock mechanically issues even more shares to the holder to compensate them. It mathematically incentivizes just relentless downward pressure on the stock.
And oh man, it gets worse. Signal Law Group also identified an additional, unusually aggressive feature in TruGolf's structure. Investors in this preferred stock are actually compensated for 5 years of future unaccrued dividends. And here's the real kicker. They get this make-whole provision converted using that exact same heavily discounted formula we just talked about. Imagine being forced to pay 5 years of interest upfront on a loan you just took out, using money you don't even have yet. As the research points out, this effectively reloads the dilution against capital that was never actually deployed, which just exponentially compounds the pain for the everyday common shareholders.
So how did this actually play out in the real world? The researchers refer to this sequence as the dilution playbook. First up, there was an exchange of $9.3 million of convertible debt for this toxic Series A preferred stock. Second, the company executed a massive 1-for-50 reverse split. It's essentially like trading in 50 pennies for a single $0.50 just to make your wallet look lighter. It artificially lifts the share price to make the stock look healthier on the surface. But then step 3, immediately after this split, the conversion price was reset downward to $2.76. So that new post-split price literally just became a fresh, higher benchmark to start the whole dilution cycle all over again.
To truly grasp the sheer danger hanging over retail investors here, you really just have to look at the capacity for dilution. Post-reverse split, TruGolf only had about 800,000 common shares actually outstanding in the market, but their authorized share capacity, meaning the absolute maximum amount of shares the corporation is legally allowed to issue at any given time, is a whopping 615 million. That is a massive overhang. It means the corporate capacity for further dilution, which is completely necessary to keep satisfying these toxic convertible notes, is virtually unconstrained.
Next up, Section 2, the passive investor illusion.
So who is benefiting from this? Now we're going to investigate the supposed SEC loophole used by the holders of these toxic convertibles. The filings actually point to an ATW-affiliated investment group. And you might be wondering, how did they hold such a powerful position without setting off massive regulatory alarms? Well, on February 4th, 2026, this ATW-affiliated group filed what's called a Schedule 13G, reporting a 9.9% ownership stake via an entity named Sand Trap Opportunities, LLC. Which honestly, you kind of have to appreciate the dark irony of Wall Street naming a shell company Sandtrap while completely tanking a golf simulator company. Now, a Schedule 13G is an SEC form explicitly reserved for passive investors, meaning people who legally certify they have absolutely no intention of influencing or changing the control of the issuer.
But let's look at the structural reality versus the regulatory filing here. They legally claim passive intent via that 13G. However, they utilize a 9.99% structural blocker. This is this really clever contractual cap that prevents them from technically owning 10% or more of the company at any exact given moment. And what that does is it allows them to continuously convert those preferred shares into common stock and then instantly sell them into the open market. It basically acts as a revolving door of dilution. They can constantly recycle their position without ever officially crossing that 10% reporting threshold that would trigger much stricter SEC oversight and legally label them as insiders.
Moving right along to Section 3, a repeating financial pattern.
Now, this is the real climax of the Signal Law Group investigation, because TruGolf, it isn't an isolated incident. If it were, you could say, well, maybe it's just one incredibly unlucky company. But the data reveals a serial pattern by ATW partners across multiple micro-cap companies. We're talking about TruGolf, iPower, Vitel, Faraday Future, and Workhorse Group. In every single case, they are hiding identically structured 9.9% positions behind uniquely named shell companies. These are special purpose vehicles with names specifically tailored to the target, like Sandtrap Opportunities or Horsepower Opportunities. The names change, for sure, but that underlying highly dilutive structure absolutely does not.
The common thread here is just undeniable. Across all these completely different companies, the public filings show the exact same control persons, individuals named Kerry Proper and Antonio Ruiz Gimenez. They use the exact same structural choices, those 9.99% blockers and the floating rate convertible debt. Signal Law Group's research points to this as a repeated pattern of bad actor activity, where the exact same dilution-heavy economic outcomes for common shareholders appear over and over and over again, systematically stripping value away from retail investors across the entire microcap space.
And finally, Section 4, Research Takeaways and Exposure.
So how do we make sense of all this? What should we take away from this crazy, complex web of Wall Street mechanics? Well, first, it is absolutely vital to state impartially that Signal Law Group frames this strictly as a probabilistic public data research review. Their own disclaimer makes it super clear. They are not making a legal conclusion here, and they're not making a formal accusation of law-breaking against ATW partners or TruGolf. They are simply reading the public signals, identifying the mechanics in play, and mapping out the mathematical, empirical outcomes of these specific financial structures.
But mapping out those outcomes leaves us with a pretty profound final question regarding market fairness. When investment groups use a repeating blueprint where they negotiate terms, mechanically reset prices, and aggressively compress equity value across multiple public companies, all while hiding behind shell names, can their intent truly be defined by the SEC as passive? Or is this simply a regulatory loophole functioning exactly as it was designed to? It is a serious question, and it's one every single retail investor needs to ask themselves before they try buying the dip on a microcap stock. Thanks for joining me on this explainer, and always remember to keep looking beneath the surface of the data.